This Week in Economics on the 23rd of September 2018, beaming from WBRN Radio and on the Bostonred Network, the Numbers Man section. Nonetheless, let's get to the chase, so to speak, here and look at the takeaways of bulletin points, the main points of this broadcast. Saudi Arabia and Russia ruled out any immediate increase in crude output and effective rebuffing the Trump administration's call to lower price petrol gasoline. The Dow Jones is reorganizing their indicators here of a global industry classification system, GICS, and we'll talk about the implications of that to various people. The Facebooks, the Googles, etc., are moving to more reflect what the market is. The weekly job claims in the U.S. fall as the labor market strengthens. Home sales are unchanged in August. And the implications of Colin Kaepernick and his political movement, the neo movement in sports, and the correlation between that and the Nike company and their sales. Many of the products have sold out. So those are the basic things. We'll start off with Reuters. And then we'll, when we finish up this particular situation and the International Settlement Bank and zombie firms, that'll be a major focus that we clear up. The U.S. part will go to the International Settlement Bank and a paper that is out and the economists that wrote the paper. And then we will place on the show the paper itself. It's about 11 pages. Firstly, to Reuters and the OPEC Russian Federation answer to the Trump administration. This is from their energy minister. I do not influence prices, here. This is from Khalifa Faisal. And told reporters that OPEC and non-OPEC energy ministers, they were in Algeria. The benchmark crude reached, where is it? At $80. The prices rally mainly stems from a decline in oil exports from OPEC member Iran. As many are aware, the sanctions on Iran will kick in very soon, and they will be effectively out of the business of the oil business as we know it. Saudi Arabia has spare capacity to raise output, but a move was not required at the moment. It might not be needed next year. That's according to OPEC projections. A stellar rise in non-OPEC product could exceed global demand growth. And this is a part of the problem here. The markets are adequately supplied. I don't know of any refine in the world who is looking for oil and is not able to get it. That's El said, adding that Saudi Arabia could raise output up to 1.5 billion barrels per day if needed. Given the numbers we saw today, that an output increase in 2019 is highly unlikely unless we have surprises on the supply and demand operation here. Higher gas prices for U.S. consumers could create headaches. And we'll finish this up and make some commentary on the administration's economic policies. Iran, of course, was the third largest producer. has accused the Trump administration of orchestrating oil price rally by imposing sanctions on Tehran, and accused its arch rival Saudi Arabia of bowing into U.S. pressure. Well, if things have changed and the prices are up, a steep rise in U.S. Oil output growth estimated for 2023. Now, this is the other part of the story here. A midterm report released by OPEC today, a forecast with non-OPEC suppliers from countries led by the U.S. would rise 2.4 billion barrels in 2014, while the global demand grows just 1.5. So in other words, what OPEC is seeing here, that countries like the U.S. will raise their output and demand will be down worldwide. Therefore, basically the old adage is they'll get their money while they can. Our attention is shifting to 2019. We have been briefed on the prospects of 2019 inventories bills, which result from significant supply growth from non-OPEC countries. And they will no doubt see this occurring. The Russian oil minister Novak said no immediate oil output increase was necessary, although he believes a trade war between China and the U.S. as well as U.S. sanctions were creating new challenges for the oil market, no doubt about it. Seeking to reverse a downturn, oil prices began in 2014. Russia and other allies decided in late 16 to reduce their supplies by 1.8 million barrels per day. June this year, however, after months of cutting more than the pack called for, largely due to involuntary reduction from Venezuela and other producers, they agreed to boost output to return to 100% compliance. That equates to an increase of 1 million barrels, but the latest data show they are some ways from achieving that target. And this is one of the problems. They can only produce so much product onto the market. OPEC and its allies cut production by 600,000 barrels more than their pack required, mainly as a result of falling output in Iran, as customers in Europe and Asia reduced purchases ahead of the U.S. sanction deadline. Iran's current production is 3.58 billion, down 300 million barrels per day. Iran's OPEC governor Arbabelli insists on Sunday that Iranian production was at 3.8, but appears to soften his stance on potential increases in OPEC output. The Iranians will still be in the game, but at the same time, their production will go down in worldwide demand. Now to the part of the Trump administration, their economic policies. We were very tolerant at the beginning of the Trump administration with their economic policies, as we covered it, and also at the same time as we did the policies of the Obama administration. But there was a different situation. There was a depression out there, and certain things needed to be done, such as lowering of interest rates to rehabilitate the economy. But what we did not see during the Obama administration, we saw some tax cuts, but not to the effect that the Trump administration has cut taxes. This is normally not done in an upturn. It's done in downturns. Classic Keynesian economics at 101. But yet this administration went against established macroeconomic principles. And at the same time, interest rates were very low and still are very low historically. and they will need to rise up. Now, during the Depression, the aftermath of the Depression of 2008, interest rates were lowered to almost zero, basically speaking. And in some countries, we had negative interest rates, which means they were below zero. Now in the U.S., they are moving interest rates up basically to 2.250. The Fed's mandate is that they have a dual mandate. Employment is taken care of more or less now. There's still some problem with it. We'll talk a little bit about it in a minute here. But at the same time, the macro part of it, financial stability, that includes the interest rates now from an American standpoint. Now in the emerging market, you can have 3.5, 4, or 5 or 6% interest rate. Rate of growth. I'm sorry about that. As opposed to 3% here. In a modern industrial market, 3% GDP, I should say, is fairly or above average. Usually, you would get in the outlying years. You're covering a lot of ground here very quickly. In the outlying years, 2019, 2020, 2021. The GDP is at least projected by the Fed and various other people, International Monetary Fund, etc., World Bank, to be around to a top of 2.5%, less than 2.5%. Now, you basically will have interest rates at the same level. In other words, we're looking at that curve. We've talked about the curve before. The curve is flat now. The curve should not be flat. So those are some things that have to be done in this current situation. Now, back to the Trump administration, their policies were Disneyland. This is a consumer economy, 70 to 80% of it. So when you cut taxes and increase government spending, particularly in the military sector, you are extending the deficit. Now, you could say, well, the deficit doesn't matter. But in classic Keynesian economics, neo-Keynesian economics, deficits, you run those up in recession times, downturns we'll call them, or depression, severe downturns, and then you start gradually to increase those interest rates. The economy now, 4% GDP in Q2, is the type of economy that traditionally central bankers would increase interest rates. There have been some at 25 basis points there, and set at the end of this month, which is next week, to increase interest rates another 25 basis points. That would be normal. Now, as far as consumers, the price of petrol does affect the discretionary buying power of consumers. And when you look at the overall economy now, no doubt there's been a lot about workers getting, I think, basically about 70 cents over the year. Well, the 70 cents would be eaten up by increase in petrol prices, which increase everything. Period. I noticed my T-Pass had went up in anticipation of the last petrol increase. So those are the kinds of things that will come in here. And at the same time, you have this administration and their tariff regime. Well, tariffs cut both ways, and historically we've looked at the smooth tariffs at one time, and many people, many historians, economic historians and historians, point to it as a precursor for the Depression. Now, systems are much more modern now. But these increase on China and other countries pushes China out of the U.S. market. And the longer China remains effectively out of the U.S. market, they will search for other market outlets and basically cut their losses is basically what China is doing. And it could take a long time. And these bargain basement retailers such as Walmart, etc., retail outlets, the price increase roughly about 10% on a lot of the products that they sell that are made in China. Now, there could be moves to other nations, but once the prices increase, retailers normally don't decrease the prices. Now, what will this mean for the holiday season? Well, it'll be, as they say, tenuous at best. Petrol increases or gasoline increases now, not like they used to be. They increase them usually for a matter of days or a matter of weeks. Normally this would happen in the summer driving season, but now it is here in the latter part of summer and fall driving season. But nonetheless, you're talking about a dime or so. We'll get to the gas at the outset of the report when we do the stock market and commodities. But this is sort of an overview of what is happening with petrol or gasoline, something that is used more in the West, in California, Arizona, which states that are more car economies. In the East, less so. In the Midwest, particularly in the Midwest, they're very dependent on the automobile. And those are the kinds of things that will raise those prices up. And if you have long commutes, like say in Montana and those places, and depending on the type of automobile that you have, if you have a SUV or a pickup type situation, it will cost you more in the tank. And that tends to impact on other things that people buy. And we'll monitor very carefully the housing situation. The housing used to be the engine that provided all, because if a person bought a new house, they would buy appliances, etc. It was sort of a supply chain bazaar, so to speak. But those things are being upset. Enough time on this. Let's go now to the reclassification here. Let's see. Wait a minute here. Oops. Now, these are the changes that are happening here in the Global Industrial Classification Standard, the so-called FANG stocks, Facebook, Amazon, Netflix, and Google's parent Alphabet remain in their current SAP sector. Oops. This is incidentally from Reuters. Facebook and Alphabet will leave tech to join expanded S&P Telecom Group, renaming communications services along with Twitter. They will accompany AT&T, Verizon, CenturyLink, which make up the old telecom sector. Apple, part of an extended FAANG group, will stay in the S&P technology sector. It will account for 20% of the index market capitalization, up from 16% once Alphabet and Facebook leave. Other names are moving from technology to communications sector: PayPal Holdings, video game, electronic arts, and Activision Bizarre. I'm not sure who they are. Netflix will move to communication services from the consumer discretion sector. where it resides, along with Amazon, which will remain in the consumer discretionary heavyweight. Disney and Comcast will also move to new sectors. So there's a lot of moving around here. The S&P will make changes after the close on Friday. These changes are meant to reflect how tech, media, and consumer industries have evolved, maintained by the S&P and MSCI since 1999. The taxonomy classifies companies across 11 sectors. The most recent created sector was real estate, split off from financials. The move allows easier route to invest in real estate trust REITs. The business models look a lot like what the cable TV companies are offering. The investment bank said, that's UBS. A research paper said telecoms have moved away from voice telephony to focus on fixed mobile data that's increasingly bundled with video content. And these are some of the things that are happening here. The old landline is basically about dead. Stocks began shipping accounts about 8% of the S&P 500, and the S&P sub-index also reflects changes on Monday. Dow Jones indexes will be affected. A higher weight in a communication service and lower profile in technologies will make a sector compensation more balanced. That is from BMO Capital Markets chief strategist Brian Belsky. The remaining communication service sector will include 3 or 4 of the FANG. Even though investors widely view them as leaders in the tech rally that has powered the market in recent years. While the tech sector is important, the S&P will fall from 26 to 20%. The changes will increase the weight of small tech companies after Apple, Microsoft, Visa, Intel Corporation, Cisco will round out the S&P Tech Index largest 5 companies. UBS has said it's not expected reclassification to significantly impact the trading in the 3 sectors. Been well telegraphed by the S&P. Their leading fund, Vanguard, started transitioning its ETFs in June. And while, State Global Advisors have already launched a new fund tracking communication services. So in other words, they are moving to the new model ahead of the model. For some funds are being significantly underweight and overweight a sector that is as sizable as communication services or as sizable as tech and consumer discretionary is going to be problematic. There is no doubt about that. Let's go to housing. Housing used to be a big barometer, but from the National Association of Realtors said existing home sales were unchanged at a seasonally adjusted annual rate of 5.34 million units last month. It followed a 4-month straight decline. A draft of properties for sale have pushed up prices, sidelining many would-be homeowners. And according to Dr. Hume, as long as we have increased inventory, I think the housing market can turn for the better in terms of sales. Supplies have been constrained by rising building material costs, and this is one of the things also coming out of this trade war, as well as land, labor shortages. They have it all going at once. The Federal Reserve will raise borrowing rates, no doubt 25 basis points. It would be the third such increase this year. Now, that meeting, incidentally, is on Wednesday. Economists at Reuters forecast existing home sales to increase 0.3%. Existing home sales make up 90% of the U.S. Home sales. Existing home sales fell 1.5% from a year ago across the nation. 4 regions, sales jumped 7.6%. In the Northeast, there was a rise of 2.4%. In the Midwest, sales fell in the West 5.9%, and 0.4% in the South. There were 1.92 million houses on the market in August, an increase of 2.7% from 1 year past. On Wednesday, data showed housing starts rose in 9.2% in August as groundbreaking for multi-family units soared, but permits were off 5.7%, the biggest decline since January of 2017. August sales, it would take 4.3 months to clear the current inventory, up from 4.1 in 2017. A supply of 6 to 7 months is viewed as a healthy balance between supply and demand. The median home price increased 4.6% from a year ago to $264,800 in August. Is a 4th consecutive month, but prices have risen less than 5% on a yearly basis. That is from the National Association of Realtors. Let's do the weekly job numbers here. They fall. We look at this, but really this doesn't have much of an impact. Employment benefits fell by 3,000, seasonally adjusted level of 201,000 for the week ending September 15th. The Labor Department is the lowest number since 1969. Well, in 1969, one thing to remember, it was a much lower labor force. And also the requirements for a worker to get unemployment were much different than today. So you can't equate the two. It's apples and oranges. And also how the reporting period is made up. The restrictions on unemployment compensation, the states administer it. In many states, it's almost utterly impossible to get unemployment compensation unless one is laid off. And they put the burden on the claimant, that's the worker, to prove otherwise. In other words, that they were laid off without a cause. Now, discriminatory layoffs, various other kinds of layoffs, they can prove that, other than there was just no work at the particular enterprise. And these are some things that surround that figure. The department said only claims from Hawaii were estimated last year. The 4th moving average of initial claims considered a better measurement. Week to week, volatility declines by 2,500 to 205,750 last week, lowest level since 1969. We've already explained that, so we won't go back to it. The claims report also showed the number of people receiving benefits after the initial week of aid fell 55,000 to 1.645 million. But that was a week ending in September the 8th, the lowest since 1973. The 4-month moving average, the so-called continuing claims, fell 20,075 to 1.69 million, the lowest since 1973, which means nothing because Again, the rules were different. The number of redundancies of people unemployed out there were much less. The economy has grown. Also, the economy has globalized. So you have global company owners you didn't have in the 70s or in the 60s in these basic industries. And also at the same time, manufacturing played a much larger part. And the whole economic makeup of the corporations were totally different. Many of the corporations that people worked for at that time are no longer in existence. And also, you did not have the Facebooks of the world, the Alphabets, Twitters, etc. That economy was not here. And it does make a difference. And also, in the banking sector, you have totally different type of banks than you had at that particular time. So there's many, many things out here. There was a little thing across from Wells Fargo. They plan to make layoffs in the next 3 years of their workers. You're going to see in the next few years, very important period, as more robotics enter the economy, and same thing with algorithms in software and business processes, that less workers will actually be needed. A lot of the interpretation now done by quote-unquote humans will be done, and increasingly done now. If you look at the market, the stock market, that is fully automated. Those people you see in the pits are just looking at numbers that are sent to them. But there are fewer people doing that type of work today than ever before. Now, analysts, people like us, there are more and more of these shops. I remember when economics.com came out, and it was one of few. Now there are thousands of similar operations that are out there. Some of the old standards are still there, but in different sectors. You have like Adobe. It used to be in the PageMaker game, software game there with graphics artists. Now they're in the analytics games, a much bigger part of their particular enterprise. And various others that are there because of the way the economy is set up with the Netflix of the world, with digital communications, internet, radio, podcasting, etc. But now that has started morphing to digital communications. So this whole communications sector is a reshifting of those groups to reflect what is actually going on. Now, in mobile communications, where you have AT&T, Verizon, I don't think they mentioned Sprint there, but nonetheless, they are further consolidating. T-Mobile, Deutschecom. So you have consolidation, further consolidation in that sector. You also have it in the software sector, and you had Salesforce buying another major part of the market. So all of these are totally changing, and other industries are going out of the business. Let's move on here. We'll just mention Colin Kaepernick and the Nike Shoe Company. I think we reported this before. This is dated on the 18th of September. Nike, I think we reported, no we didn't. Anyway, sold about 61% more merchandise since the Colin Kaepernick ad went up. The first tweet ad was on the Labor Day weekend, and the administration, of course, opposed it. They don't need to participate in discounting that trend to plague other retail brands. Shares have rebounded from an initial drop when the version of the ad first came out. They're now up 7% since the drop, outperforming 1.9% gain of the Dow. held by four analysts raising the price target there for first quarter results. Social media sentiment around the company, which dove in the immediate aftermath, also positive earlier this week. That's at Thomson Reuters. This is another one here. Social Media Monitor. The Nike Just Do It ad campaign was a stroke of genius, and it premeditated moves. There was another subtle but significant sign of Nike's strength and confidence in its position in the marketplace. That is from an analyst at Camelo Lyon. Camelo Lyon is the analyst. And Canaccord, Castello Lyon is the company wrote in a note. So that is that part of the situation. Let's visit Lehman Brothers. We didn't have it out there. Lehman Brothers workers share memories 10 years after the fall. Ex-workers from a Lehman Brothers holding met in an Irish pub. I guess it was an Irish wake near their former office in Midtown Manhattan to reminisce on 10 years after the collapse in a gathering atmosphere of a high school reunion. More than 100 traders, lawyers, recruiters who worked there shot the breeze at Conley's pub and the Playwright Tavern blocks away. They recall the times of Lehman, which had a reputation as scrappy underdog competing against Goldman Sachs, J.P. Morgan. They may have been scrappy, now they're out of the game. Vanessa Jangelberg, who was one of Lehman's few female managing directors in equity, recalls the earning the nickname Wiener when she first joined the firm. That was in 1989. After the after the Wheel of Fortune, Vanna White. She thinks a trader based on West Coast bestowed the nickname because he thought she looked like the TV star. Perhaps so. It was the greatest ride of my life. Jangenberg, I get that name, was memories with a former colleague, Ron Gold, who worked in sales. After seeing many of the 26,000 colleagues lose their job, Daryl Kimball bought an outplacement service firm now called Get 5. I had a great first career, Kimball said, and worked in equity research, sales, and trading at Lehman, but I don't miss being a slave to stock going up and down on Tuesday. Matt Lewis worked in the subprime loans at pitching securitizations to clients who originated loans. Now he uses his skills at a boutique firm, but because the mortgage market has changed dramatically since the crisis, much of Lewis' business has dried up. So that's some of what is going on here. We'll go now to our story here. This is from the people at the BIC. And this will be Raymond Banerjee. He's a senior economist there, and he will talk about the zombie funds, the cause and consequences of it, and also Boris Huffman. It was two, evidently. I'm looking at the paper itself. We'll the Bureau of International Settlement. We'll go to him, and then we'll have some commentary after his commentary. Very short, only a minute or so.
Zombie firms are mature firms that are persistently struggling to repay their debts and not expected to be strong performers in the future. Their prevalence has increased over the past 30 years in advanced economies. Using a broad measure, the share of zombie firms has increased from around about 2% in the 1980s to around about 12% today. With each economic downturn, their numbers seem to increase, but when the economy recovers, their numbers stay high, creating a sort of ratcheting up effect. Some people think this is caused by weak banks, and weak banks have incentives to roll over loans to weak firms, keeping them on life support. We find that the long-term decline in interest rates since the 1980s has also been important in keeping zombie firms alive. In particular, compared to the 1980s and 1990s, today zombie firms seem to face less pressure to reduce their debt and cut back their activity. In fact, today, changes in debt in zombie firms are almost indistinguishable from that of healthy firms. Zombie firms drag down productivity in the economy, and this occurs through two channels. First, zombie firms are less productive than healthy firms, and thus their growing prevalence mechanically pulls down productivity. Second, by competing for resources, zombie firms hold back investment and employment growth in more successful firms, and this jams up the productivity-enhancing reallocation of resources towards those more productive and successful firms.
That was Dr. Banerjee, and of the paper that is coming up here. The zombie firms, meaning firms that are unable to cover debt service costs from original profits over an extended period of time, have been increasingly attracted increased attention both in academic and policy circles. Cabrillo and Elot in 2008 coined the term in their analysis of Japan's lost decade. The most recent McGuinn in 2000, Elot in 2017 showed that the prevalence of such companies as a share of total population of non-financial companies, the zombie shares has increased significantly in the wake of the depression across advanced economies. In this special feature, we will explore zombie companies and its causes and consequences. We will take an international perspective that covers 14 countries and a much larger period than previously studied. The focus list of companies allowed us to consider two different ways of identifying zombie firms, a broad measurement proposed by McGuinn based on a persistent lack of probability in mature firms, and a narrow one proposed by Hoffman and Banerjee, which additional requirements, expectations of low future probability infers from a firm stock valuation. Our analysis address three major questions. First are the increase in incidence of zombie firms just epidictic linked to major financial disruptions, or to or do they just reflect a general sector trend? Answering this question requires taking a significant long perspective. Our database extends back to the 80s and covers several business cycles. We find a wrenching dynamic. The share of zombie companies has trended up over time, though upward shifts in the wake of economic downturns are not fully revised in subsequent recoveries. The takeaways here: the prevalence of zombie firms has ratcheted up since the 80s. This appearance to be linked to reduced financial pressures, reflected in part on the effects of lower interest rates. Zombie firms are less productive and crowd out investment in and employment at more productive firms. While identifying zombie firms, it appears to be important to take into account the expected future probability in addition to weak post performance. Second, there are causes of the rise of zombie firms. Previous studies have focused on the role of weak banks that roll over loans to non-viable firms rather than writing them off. Keeping zombie firms on life support. A related but less explored factor is a drop in interest rates since the 80s, the ratcheting down in the level of interest rates after each cycle has potentially reduced financial pressure on zombie firms to restructure. That is Burrow and Hoffman, 2017. So this is fairly current data and big data here. The remaining special effect is organized as follows. The first sector documents and the uptrend in the share of zombie firms since the 80s. The second assesses the cause of their rise, and the third explores the consequences for productive and a non-performance of the zombie firms. Now, incidentally, Tesla and Netflix were named here. We've applied two alternative zombie classifications to list non-financial corporations in 14 advanced economies using world scope data covering 32,000 companies. And they have to be at least 10 years old. Let me see. Have been less than one for at least 3 consecutive years. And at least 10 years old. Let me just go back over this. This is McGuinn in 2017 identified a firm as a zombie if its interest rate ratio, ICR, has been less than 1 for at least 3 consecutive years and if at least 10 years. The second measurement is narrow, following Hoffman and Banerjee, exploring the fact that our database covers only listed companies for which we have observed the stock market valuations. It adds the requirement that zombies should have a comparatively low expectation future growth potential. Specifically, zombies are required to have a ratio of their asset market value to their replacement costs. This Tobin here. Zombies on the two definitions are very similar with respect to current probability, but quantitatively different in their probability prospects. As the majority of zombie firms make losses in medium ICRs are below -7 onto the broad measurement of around a -5. I won't get much into that. You can read the paper, which is a little bit more detail. Both zombie measurements suggest that the prevalence of zombies have increased significantly since 1980. In the 14 advanced economies, their shares rose on the average from 2% in the late 80s to some 12% in 2016. How can a corporate zombie survive for longer in the past? It seems to face less pressure to reduce the debt. This is from the Reuters article also. Regression estimates suggest that pre-2000 zombies, broadly and narrowly defined, cut their debt rate at just only 2% of total assets a year relative to non-zombie firms. Post-2000, however, the two groups became indistinguishable. Zombies at deliberate aging speed have slowed down significantly. There was a full mid slowdown in 2009. That was during Depression. It was not statistically significant. Factors that change in zombie behavior. Weak banks is portrayed a key cause. That is Cabello, 2008. That was during Depression when their bank sheets are impaired, banks have incentives to roll over loans. Another potential, more general factor is the downward trend in interest rates. Mechanically low interest rates should reduce our measure of zombie firms as they improve. And that used to be the case, but not the case now. It's business as usual. They're just rolling these firms over. Let me quickly finish this up. Conclusions. What do our results mean for central bank policies? Amongst other things, they highlight a difficult trade-off. Low interest rates boost aggregate demand and raise employment, investment in the short term. Now, remember, that is the short term, but higher prevalent zombies they leave behind, misallocate resources, measured, weighted on productive growth. Should this effect be strong enough to reduce growth, it even deepens, interest rates further. Our study cannot answer the question. We leave it out there, and we'll put both of these up, the short version and the long version. Now we take a break here, and we shall return. WBRN Radio. Here's some gas pricing from the AAA. The average price, $2.85. That's for regular, and if you go to premium, it's $3.40. Diesel at $3.18. And a year ago, this price was $2.58. This is regular, and premium at $3.10. So you can see about a 30% increase there. And if we go to gas buddies, we'll go to the West Coast. We'll go to Los Angeles. This is in California, and just a minute here. Basically, the gas prices there. We'll go to, where will we go? Los Angeles. At Arco, $3.35 at Arco, that is in Los Angeles, and $3.39 at another Arco. So you can see where these prices are moving from the AAA model at $2.85 to $3.35 in California. And if we go to San Francisco in the Bay Area, we won't spend as much time on this as, let's see. They've got this all over the place here, unfortunately. Okay, this is... And if we go to... we'll do San Francisco now. This is their metro area. They're $3.49. Something you could expect to go on up to. That is a gas and shop and mobile. The mobile company, $3.47. Almost $3.50 up in the Bay Area. If we go to New York, we have to do a little bit of this. And really low prices here. We'll do New York City. We won't mess with Rochester and Syracuse. $2.73, that is in Queens. And in Brooklyn, it's $2.79, a little bit below the national price. So that is where it stands. The prices are going up. And we go to the Midwest. We'll go to Illinois, I suppose, and Chicago. This is a Costco, $2.89. A little over the national average, but pretty close to the national average here. Go on, Cicero. This is Clark, a major supplier there. Roughly $2. We'll go to Martin Luther King Drive. That's on the south side of Chicago. 87th Street, $2.95 at Frontline. And in Homewood, Illinois, same thing. This is south. It costs more on the south than on the north side there. Homewood, Illinois, $2.95. About 10 cents above the national average. Let's now go, I think we're going to, where are we going to? And we'll do the Bloomberg with commodities, and then we'll do the BBC here a little bit clearer. The FTSE 100 at 1.67. In Amsterdam, 0.43. In France, at 0.78. All in the positive. The DAC in Germany was at 0.85. Eurostat at 0.81, and in Spain they were at 0.07. Let's skip around a little bit here and go to Asia. The Hang Seng was at 1.73. The Nikkei was at 0.82, and in Bombay they were in the negative 0.75 in Bombay. The Dow was at 0.32. The Nasdaq was at negative 0.51. And out in Chicago, they were also negative at 0.4. And let's see if we can get our commodities here. This is Brent crude futures, evidently at $80. This is what we have here. At $78.80. West Texas crude at basically $70.80 there. And gold on the Forex at $1,207.60 there. And let's jump back to Bloomberg, the commodity index at 1.08 is the change there for the Bloomberg commodity index. The high is 1.7. Excuse me, is 175.01. The low was 173.32. And we now have it at 1.74. Let me start over again. 174.59. I'll get it right in a minute here. The UBS index at 4.60. The Reuters Jeffers 199.71, and the Rogers International at 2.485. The gasoline index, let me see where they are. Change has been 25 cents at 201.17. Natural gas, this is all on the WMX, at 2.98. Heating oil was down 20 cents. Precious metals were down. This is the Comdex, $1,201.30, down $10. On the spot, it was at $1,204.04, was down $7.14. Silver down, what? It looks like 5 cents at $14.36. Copper, for those who want to know it, was up $11.79. Platinum was down $5.51. Corn was up $4.15. Wheat was down $2.25. That was a farm report. I lived in Chicago. Hey, cotton was up 56 cents. I have this in a shallow green. Live cattle was up 56 cents. So that is our commodities report, and make sure that we got everyone. We look at the Bloomberg. We had the BBC one here. The NASDAQ composite was down 41.28. And the Dow at 86.52. Okay. And let's see what else here. I think we gave the, yeah, we did. The FTSE 100, we gave that already. The DAC, the CALC, and in Spain, we don't want to miss anyone here. The Nikkei, the Tropic. I don't know. We gave the Tropic at 16.42. The Hang Seng. I don't know why the BBC didn't have the Hang Seng in here. At 4.75.91. In Shanxi, I think this is what it is here. Let me just, okay. Where did Shanxi go? Oh, it's right there. At 3.03, that was the Shanxi. A few, the Asian Pacific, we do Shanxi here. It was a plus 100.36. Let me just get that right. Be consistent here in what we're doing. And I don't know if we'll do the MAC fund or not. This is the Asian Pacific here. 2-day net change. Anyway, it's down 11.13. That's in Shanxi. From 1 year in the past. So I suppose we could have given it that way. Anyway, this is our basic roundup. We went a little bit over, but basically you see the global, the Dow Jones indicators being reorganized. It's a global industrial classification standard. And the jobs report, which didn't reflect anything, they were measuring since 1969 and the early 70s. Totally different economy there. Don't like to have those comparisons because those comparisons are not exactly what we want to have real time. I'll try to get some better figures out on the jobs market. We are continually searching here at numbers, man, for the better mousetrap, so to speak. We have that International Settlement Organization. We'll put that on. Talks a lot about the economy, or addresses banks, how banks like to roll loans over, how the Netflix of the world, their loans are continually being rolled over. Now, what happens? This is sort of like akin to, I guess is the word, the balloon mortgage. You go in at a low interest rate, and then the interest rate balloons up, and that tends to be a problem. Now, this is not exactly that dynamic, but the interest rate will go up, and this is what happened in Japan. They had a 10-year drought there. Now, that is not inflation. That's called deflation, and we've talked about that on Numbers Man before. Very hard, difficult to get out of. Japan is now has now pulled out of their deflationary period. So next week we'll of course talk about the Fed's interest rate. As we've been talking about interest rates, different schools of thought obviously on where interest rates should go. When interest rates are increased in say the US or in the UK, etc., that affects emerging economies. We've looked at Ghana and a few of the emerging economies. The interest rate that they pay will go up, and of course their GNP will be affected. It'll be infected too. So in other words, there are a number of things to look at in how the global economy performs. But with the tariff regime here, gas prices going up. Even if the gas prices only stay up, and they evidently dropped. They were at 80, what they had from Reuters there, and they're now at $70 and change. Look at the Reuters article here. I think we still have it. We may or may not have it. I probably took it away. But anyway, nonetheless, it was at that particular time up. I don't know if I can find it just through the report and see exactly where it is. Here we go. This was from Reuters, and the look at the date of this. It is the 23rd. Anyway, the benchmark reached $80 this month. I'm sorry, I guess I didn't read it there. And reiterates that. So it's actually went up and it's dropped. But what happens, those are on contracts. So now gas prices actually in the U.S. have creeped up. This will do it for us, for those in business. Have a productive week. For the consumer, keep your eye on the prize. We haven't seen any significant gains in retail on the so-called back to school. That's been dropped. We'll have to look at that for next week's show. I'll make a note in the old notebook here of things to look at.